Ladies and gentlemen, Asian guy here. Stop what you're doing. Put down the coffee. Close the Bloomberg tab. This is not a drill. What just happened in the plumbing of the financial system is a crime scene, and the fingerprints are still wet. While the talking heads were busy debating rate cuts like it's a beauty pageant, the banks were screaming for cash. Not cheap money. Cash. Immediate liquidity. And when the repo window lights up with a $34 billion injection, that is not business as usual. That is an emergency flare shot straight into the night sky. Let me be very clear, because mainstream media will not be. This was not a vote of confidence. This was not markets functioning smoothly. This was a financial assassination attempt that failed, and the cover-up is happening in real time. CNBC and Bloomberg are gaslighting you, telling you everything is fine while the pipes are rattling and the pressure gauges are redlined. When banks need repo injections, it means collateral is failing, balance sheets are choking, and someone, somewhere, could not roll funding. That is mechanical reality, not opinion. The system is a rigged casino run by algorithms executing mechanical orders at the speed of light. Humans are not in control. When you see V-shaped moves, when you see rates ignored, when you see metals smashed at the open only to levitate on no volume, that is not price discovery. That is mechanical execution. It's a script running until it breaks. And tonight, ladies and gentlemen, it cracked. Ask yourself the most basic question. If rate cuts are coming, if everything is so bullish, why did the system need a 34B repo shot? Why now? Why overnight? Because the problem is not rates. The problem is collateral. The problem is that paper promises are colliding with physical reality. And physical reality always wins. This is why I keep telling you to stop listening to ghost signals. Headlines are hallucinations designed to keep you calm while they move the exits. The repo market does not lie. It is the plumbing. It is where fear shows up first. When banks show up begging for cash, it means something broke behind the curtain. And when the Fed obliges quietly, it means they are terrified of daylight. You are watching a system trying to buy time. Digits being created to patch holes in a ship that is already taking on water. This is financial Armageddon by 1,000 cuts, not one big explosion. And the reason they need you distracted is simple. As long as you believe this is about rate cuts and soft landings, you won't notice the real move out of paper derivatives and into physical atoms. This is the moment you were warned about. Not tomorrow. Not next quarter. Now. Because once the public figures out that the repo injections were the warning sirens, the exits get very small, very fast. Stay sharp. Stay focused. And understand this. The game just changed. You want the truth? Here it is, stripped of narratives and buzzwords. What you just witnessed was not a market reacting to news. It was a machine responding to stress, mechanical execution, cold, scripted, non-negotiable. Markets today do not think. They trigger. They cascade. They execute if-then statements written years ago by quants who assumed liquidity would always be there. That assumption just got challenged. Mainstream media wants you to believe prices move because of sentiment or because some Fed official blinked too slowly at a podium. That's a fairy tale for retail consumption. In the real world, price is a derivative of leverage, margin, and collateral velocity. When collateral quality degrades, when rehypothecation chains snap, the machine does one thing: it liquidates. Not emotionally, mechanically. Those violent V-shaped shocks you keep seeing, that's not buyers stepping in with conviction. That's algorithms slamming bids and offers because risk limits were breached and then relaxed. It's a heartbeat monitor, not a love letter. Down hard, up fast, zero follow-through. That is the signature of a market being propped up, not believed in. Bloomberg will tell you, stocks shrugged off concerns. CNBC will smile and say, markets looked through the noise. Lies. Total gaslighting. There's no shrugging in a mechanical system. There's only execution. If volatility spikes and liquidity vanishes, the system sells what it can, not what it wants. Then, once the central bank injects digits, the same system is forced to re-risk because cash is trash in a leveraged world. That's your V-shock. Not optimism. Coercion. Look at the timing. Look at the symmetry. Smashes at the open. Ramps into the close. Futures doing things that make no sense if humans were actually in control. This is not price discovery, it's price enforcement. A rigged casino where the house adjusts the odds mid-hand because too many players are about to win. And here's the key point mainstream narratives avoid. These moves are defensive. They are not bullish expressions of growth or confidence. They are stress responses. When the repo market lights up, when overnight funding needs emergency injections, it means primary dealers were in trouble. It means balance sheets were constrained. It means someone hit a wall, and the only thing preventing a cascade was central bank intervention. You're being told this is liquidity management. That's like calling a heart attack cardio optimization. Normal markets do not require emergency liquidity. Functional systems don't need daily patches. If this were truly stable, rates would matter. Fundamentals would matter. Instead, everything gets steamrolled by mechanical flows. This is why gold and silver get smashed on no news. This is why yields can fall while the dollar rises. This is why logic no longer applies. Because logic assumes free markets. We do not have free markets. We have managed outcomes, algorithms defending narratives. Paper derivatives are the weapon of choice here. Infinite leverage, infinite supply. Futures contracts dumped in quantities that exceed annual mine production in minutes. That is not selling, that is signaling. It is meant to tell you that reality is irrelevant, that price is whatever the screen says it is, until it isn't. And every time you see these ghost signals, headlines explaining moves after the fact, remember this. The explanation is always reverse engineered. Price moves first. Narrative comes later. They tell you a story so you don't ask the real question. Who needed liquidity and why? Mechanical execution also explains why interventions no longer shock markets. They are expected, priced in. The machine anticipates the bailout. That's why risk keeps coming back no matter how bad the data gets, because the model assumes the Fed will always show up. Moral hazard coded directly into the algorithm. But here's where it gets dangerous. The more they intervene, the more distorted the signals become. The more paper claims stack on top of the same collateral. The system becomes brittle. One wrong input, one failed auction, one counterparty hesitation, and the entire structure starts to resonate like a cracked bell. This is not theory, this is observable. Repo injections are not bullish, they are life support. And life support patients do not run marathons. They survive hour to hour. So when you hear nothing to see here, understand that this is not ignorance, it's intent. They need you calm, they need you passive. Because the exit strategy for institutions is not the same as yours. They move first, they move quietly, they move into things that cannot be printed. Mechanical markets eventually collide with physical limits. Algorithms don't understand scarcity, they only understand margin. And when margin meets reality, something has to give. That's where we are. Not at the beginning of a boom, but in the late stage of a controlled unwind. And the only people who get hurt are the ones who believe the headlines instead of the plumbing. Good, because now we go where the math exposes the lie, and numbers don't care about narratives. Let's talk arbitrage, because this is where the entire paper illusion collapses. In a functioning market, prices across geographies converge. That's not ideology, that's mathematics. If silver is cheaper in New York and more expensive in Shanghai or Tokyo, metal moves. Traders buy low, sell high, and the spread closes. That's how real markets work. That's how they are supposed to work. But that mechanism is broken, completely. Look at the numbers. In New York, you're staring at a screen price around 71. Paper ounces, futures, promises. Meanwhile, in Shanghai, physical settlement pricing implies something closer to 89. In Japan, depending on form and delivery, you're talking about effective prices north of 130. Read that again. Same metal, same atomic structure, wildly different prices. That spread should not exist, not at this scale, not for this long. And before the apologists jump in screaming taxes or transport costs, stop. Even if you stack insurance, shipping, premiums, and handling, you do not get a 20, 40, 60% gap. That gap is screaming one thing and one thing only. The metal is not moving. Why isn't it moving? Because the arbitrage mechanism requires deliverable supply. Not paper, not contracts, not ETFs. Physical, bars, kilograms, tons, and those bars are not leaving the vaults. This is the smoking crater in the ground. The arbitrage math proves the market is bifurcated. One price for paper, another price for atoms. Two different universes pretending to be one. If physical silver were abundant, traders would drain New York inventories, ship the metal east, and collapse the spread. That's free money. Institutions live for that trade. The fact that it's not happening tells you everything you need to know. The metal isn't there, or it's spoken for, or it's locked behind promises layered 10, 20, 50 times over. This is what I mean when I say the system is lying to you. The paper price is a derivative of leverage, not scarcity. It is set at the margin by contracts that can be created infinitely. Shanghai and Tokyo are pricing reality, what it costs to actually get your hands on the metal. And here's the part that should make you uncomfortable. The longer this spread persists, the more violent the resolution becomes. Markets hate imbalance. Nature hates imbalance. Physics hates imbalance. You can suppress it for a while with digits and force, but eventually the energy releases. Historically, arbitrage breaks one of two ways. Either physical prices collapse to paper levels because supply floods the market, or paper prices reprice violently higher to meet physical reality. Given mine supply constraints, industrial demand, and visible vault drains, ask yourself which path is even remotely plausible. This is not about speculation. This is about logistics. Can metal be sourced at scale, delivered on time, and replaced? Right now, the answer is no. That's why premiums stay elevated. That's why delivery times stretch. That's why eastbound flows slow to a trickle. The New York price exists because settlement is optional. Cash is allowed. Paper can be rolled. In Asia, settlement is expected. You don't show up with excuses. You show up with metal. Different rules, different cultures, different outcomes. So when analysts tell you global prices are aligned, they are either ignorant or complicit. The alignment only exists on screens. In the real world, the spread is a canyon. And here's the kicker. The arbitrage trade is being attempted quietly, desperately. But it's failing because the supply chains are tapped out. You cannot arbitrage what you cannot source. You cannot move what does not exist. This is why physical markets are sending distress signals while paper markets pretend everything is fine. This is why Shanghai premiums refuse to die. This is why Japan keeps paying up. They know something the screen traders don't or won't admit. Paper derivatives were designed to absorb demand without requiring delivery. That worked when demand was mostly financial. It stops working when demand turns industrial and strategic. When you need the metal to build things, not just trade things, the game changes. Arbitrage math is merciless. It tells you the system is fractured. It tells you price discovery is fake. It tells you that one side of the market is being suppressed to protect balance sheets that cannot survive honest pricing. This is not a temporary anomaly. This is structural failure. So the next time someone points at a New York chart and tells you silver is cheap, ask them cheap relative to what? A promise or a bar that actually exists? If you're ready to see how this connects directly to emergency repo injections and silent bailouts, say the word. Then let's rip the curtain down, because this is where the plumbing meets the crime scene. Repo injections are not policy tools. They are emergency measures. Full stop. When you see $17 billion, $34 billion slipped quietly into the system, that is not the Fed being generous. That is the Fed being cornered. Repo is where banks go when they need cash now, not tomorrow, not after a committee meeting, now. And the only reason you ever need that kind of cash is because something on your balance sheet stopped behaving the way the model said it would. This is institutional triage. The official story is always the same. Technical adjustment, seasonal funding needs, smooth market functioning. Lies. If the system were smooth, there would be no need for injections. If collateral were trusted, there would be no scramble. Repo stress means one thing. Someone did not trust someone else's collateral, or worse, someone could not fund it at all. This is where the secret bailouts live. Not on the front page, not in press conferences. In overnight operations, balance sheet swaps, and quiet extensions that never get unwound. The Fed doesn't print money and throw it out of helicopters anymore. It surgically injects digits into the veins of institutions that are too big, too interconnected, and too fragile to fail publicly. And here is the detail they done to want you focusing on what collateral was posted. Treasuries, mortgage paper, something else. Because repo is collateralized lending. If banks were sitting on pristine assets, this would be cheap and easy. The fact that it wasn't tells you the quality was in question. Haircuts matter. Trust matters. And trust is evaporating. This is also where the blue whale flip happens. Big money doesn't panic like retail. It rotates. When stress hits, institutions that were short metals, short volatility, short reality, start covering. Quietly. They don't chase price on the screen. They secure exposure off screen. Long physical, long strategic assets, short paper narratives. You'll notice something interesting when repo injections spike. Metals get hit first. Why? Because smashing paper prices relieves pressure on derivative books. It lowers margin requirements. It buys time. That is not accidental. That is coordinated defense. But underneath that paper smash, the whales are flipping. Shorts become longs. Leverage gets reduced. Risk is transferred. They are not betting on growth. They are hedging against system failure. But that's what bailouts are really about. Time to reposition. And let's be very clear. These are bailouts. The only difference between now and 2008 is presentation. Back then they panicked in public. Now they panic in private. The sums look smaller because they happen more often. Death by 1,000 injections. Why do you think the Fed is so obsessed with keeping this quiet? Because confidence is the last pillar holding this thing up. And once the public realizes that banks need constant life support, the game is over. You cannot have a confidence-based system where confidence is gone. This also explains why regulation theater is so intense. Stress tests, capital ratios, all optics. Meanwhile, the real action happens overnight, off-balance sheet, and retroactively justified with footnotes no one reads. Repo is the heartbeat of the system. When it skips, you don't need an economist, you need a doctor. And the patient right now is not healthy. It's stabilized, temporarily, with borrowed time. This is why I keep saying rate cuts don't matter. You can cut rates to zero, to negative, to fantasy levels. If collateral is distrusted, lending stops. Liquidity freezes. And the only entity left standing is the central bank, acting as buyer, lender, and counterparty of last resort. That is not capitalism. That is managed survival. And every time they do this, the hole gets deeper. More digits chasing fewer real assets. More paper claims stacked on the same physical base. The leverage pyramid grows taller while the foundation erodes. This is why physical markets don't believe the screen. This is why arbitrage is broken. This is why industrial buyers are locking in supply years in advance. They can read the plumbing. The repo injection was not the story, it was the confession. If you're ready to see how industrial demand turns this stress into an outright supply shock, say the word, here's where it stops being abstract and starts getting physical, heavy, unignorable. Industrial demand is the accelerant. This is the part the financial media cannot model, cannot spin, and cannot stop. Because factories don't run on narratives, they run on inputs. And one of those inputs, silver, is quietly becoming unobtainium. Let's start with the industrial bomb nobody on CNBC wants to touch. Solid-state batteries. Not prototypes, not lab toys, production pipelines. Samsung and others are moving toward architectures that dramatically increase silver intensity. We're not talking grams. We're talking kilograms per vehicle in certain configurations. One car, 1 kilogram. Multiply that across EV adoption curves and defense storage requirements and grid scale systems, and the math goes vertical. Silver is no longer just an investment metal. That framing is obsolete. Silver is an industrial metal with monetary DNA, and that combination is lethal to paper markets. Because industrial buyers do not substitute. If they need silver, they need silver. They do not care about COMEX prices. They care about delivery certainty. Now, layer in geopolitics. China has already shown its hand with export controls. Gallium, germanium, rare earths. The message is clear. Strategic materials will be weaponized. Silver is next, whether formally announced or functionally restricted through licensing, quotas, or environmental reviews. You don't need a headline ban. All you need is friction, and friction is everywhere. Look at the vault data. COMEX inventories bleeding. Asahi and other refineries seeing outbound flows that do not come back. Eligible turning into registered, registered turning into delivered, delivered turning into gone. This is not speculative churn. This is physical exit. When metal leaves the vault system, it rarely returns. It goes into industry, into sovereign stockpiles, into long-term storage, out of circulation. Every ounce that exits reduces float. Every reduction in float increases stress on paper claims. This is why I call silver a war metal. It sits at the intersection of energy, electronics, defense, and currency. Missiles, drones, solar arrays, data centers, silver is embedded everywhere. You cannot replace it easily. You cannot ramp supply quickly. Mining lead times are measured in decades, not quarters. And here, as the quiet horror for the paper market, most silver is produced as a byproduct. You don't just mine more silver because price goes up. You have to mine more copper, lead, zinc. That means supply is inelastic. Demand is not. This is the setup for a squeeze that does not announce itself. No fireworks, no meme frenzy, just metal disappearing, premiums rising, delivery delays stretching, and eventually one failed promise. Paper markets assume optionality, cash settlement, rollovers, IOUs on IOUs. Industrial buyers do not play that game. They want atoms. They want bars. They want them now. This is why calling silver cheap is a category error. Cheap relative to what? A futures contract that can be printed infinitely? Or a bar that must be mined, refined, transported, and defended? The vault drains are the tell. You don't drain vaults in a surplus. You drain them in a shortage. And you don't drain them quietly unless you're trying not to spook the market. Every ounce leaving the system tightens the noose on shorts who assumed they could always source metal at screen prices. That assumption is dying. And when the physical market finally says no, there's no algorithm that can override it. You cannot print silver. You cannot repo silver into existence. Atoms don't respond to QE. This is the moment where mechanical execution hits a wall. The machine keeps selling paper, but the physical side stops responding. That's when spreads blow out. That's when delivery fails. That's when confidence snaps. We are not there yet, but we are close enough that the behavior has changed. Institutions know it. Industrial buyers know it. That's why they're moving early, quietly, relentlessly. This is not about getting rich. This is about not being trapped on the wrong side of a physical shortage with only paper in your hands. The war for silver will not be televised. It will be settled in warehouses, factories, and contracts that suddenly cannot be honored. If you're ready for the battle plan, what to do, what to ignore, and how to exit the paper maze, say the word. This is where we end the fantasy and start talking survival. Not trading tips, not price targets, a battle plan. Because 2026 is not about maximizing returns. It's about minimizing regret. The first rule is psychological. Detach from screens. Screens lie. They are optimized to keep you reactive, emotional, and late. If your entire understanding of the world is mediated through digits that can be changed, frozen, or reinterpreted overnight, you are not an investor. You are a passenger. This is where the shift from digits to atoms becomes non-negotiable. The system is telling you in plain mechanical language that paper claims are infinite and physical reality is not. Repo injections, broken arbitrage, vault drains, industrial hoarding, these are not separate stories. They are one story told from different angles. A system drowning in promises and starving for substance. Now let's talk about the 5 and 200 rule, because this is how you stay alive when volatility stops being theoretical. Rule number 1, never have more than 5% of your net worth in any single paper counterparty you cannot physically access or immediately exit. Banks, brokers, platforms, it does not matter how big they are. Size is not safety, size is fragility. Concentration is how people lose everything in events they were told were impossible. Rule number 2, if you cannot personally verify it within 200 miles or 200 minutes, assume it does not exist when you need it most. That applies to assets, access, and promises. Distance is risk. Complexity is risk. Anything that requires multiple intermediaries to function will fail when intermediaries start protecting themselves. This is not paranoia. This is pattern recognition. The exit strategy is boring by design. Boring keeps you alive. Reduce leverage, reduce dependency. Increase ownership of things that do not require permission. Physical metals, energy, productive assets, skills, redundancy, optionality. Do not wait for confirmation from mainstream media. They are structurally incapable of warning you. By the time they admit there's a problem, the exits are gated, the rules are changed, and the narrative flips from everything is fine to why didn't you prepare? This is also where you stop thinking in terms of upside and start thinking in terms of asymmetry. What hurts you the most if you're wrong? If you hold paper and the system hiccups, you're exposed to counterparty risk you cannot control. If you hold physical and the system limps along longer than expected, you lose nothing but opportunity cost. One of these risks is survivable, the other is terminal. The biggest lie sold to you is that preparation equals pessimism. It doesn't. It equals independence. The people who survive regime changes are not the smartest or the most optimistic. They are the least dependent. Understand this clearly. The system will not warn you before it reprices. It will distract you. It will soothe you. It will tell you to focus on rate cuts, elections, and quarterly noise while the real moves happen underneath. You were given the signals. Repo stress, broken arbitrage, physical drains, industrial hoarding. These are not opinions. They are facts. What you do with them is the only variable left. Do not wait for permission. Do not wait for consensus. Consensus is how people get trapped together. Move early. Move quietly. Move into reality. Because when this finally resolves, and it will, the difference between those who panicked and those who prepared will not be intelligence. It will be timing. I will see you on the other side. Like, subscribe, and share.